Welcome back, navigators. In this video, I discuss practical tips, techniques, and strategies enabling you to select healthy and profitable companies to invest in the stock market. Did you think before about how you can choose stocks for building a long-term wealth? It may seem like a complicated task, but with the right approach, it can become an exciting journey. You see, stock picking isn't just about buying low and selling high. It's about understanding the underlying health of a company and its potential for growth. So what makes a stock healthy? Well, a healthy stock typically belongs to a company that's financially sound, has a strong competitive advantage, and is led by competent management. These companies often show consistent profitability and have a track record of delivering value to shareholders. But remember, while these factors are important, they're not the only elements to consider. The key is to develop your own approach, tailored to your personal circumstances and objectives. As we will see, the art of stock picking is more science than luck. The world's most successful investor, Warren Buffett, became a billionaire by investing in healthy companies. Buffett's philosophy is simple: buy undervalued companies with strong fundamentals. He's not one to chase after the latest hot stock or the trend of the moment. Instead, he dives deep into the company's financial health, looking at things like its earnings, cash and debt levels, and competitive position in its market. Take, for instance, Buffett's investment in Coca-Cola. He saw a company with a powerful brand, strong cash flow, and a product that people around the world loved. He bought shares when they were undervalued, and the rest is history. Then there's Apple, a tech giant that Buffett invested in, not because it was a tech trend, but because of its strong fundamentals, excellent leadership, and loyal customer base. As Buffett demonstrates, the key to long-term wealth is not about chasing trends, but about investing in fundamentally strong companies. So what are the fundamentals of a healthy stock? To start, strong financials are a must. This means a company's balance sheet should be solid, with assets outweighing liabilities. Next, we have consistent earnings growth. Just as we value consistency in all areas of life, we cherish it in the stock market too. A company that consistently increases its earnings year after year demonstrates reliability, much like a dependable friend who always shows up when needed. Then we consider low debt. A company with low debt is like a person living within their means. Also consider the industry, since asset-light firms, service providers, are less indebted than, say, telecom, utilities, or industrial ones. It suggests the company is managed responsibly and isn't overextending itself. Lastly, a competitive advantage, or what Warren Buffett calls a moat, is a critical indicator of a healthy stock. A company with a unique product, service, or brand that sets it apart from competitors is like a castle with a wide, unbreachable moat. This moat protects the castle from attacks, just as a competitive advantage shields a company from competition. Each of these indicators, strong financials, consistent earnings growth, low debt, and a competitive advantage, are like the vital signs of a healthy stock. They help us assess if a company is fit for investment, much like a doctor checks a patient's health. There are various online stock screeners that allow you to select stocks based on the above criteria. It is also wise to read separate news about industry and general stock market status before investing. Another successful investor, Peter Lynch, had his own strategy for picking healthy stocks. Peter Lynch, renowned as the Wizard of Wall Street, adopted a unique approach to investing. He believed in investing in what he knew and understood, a philosophy that might seem simplistic, but its effectiveness can certainly not be understated. Take, for example, his investments in Dunkin' Donuts and La Quinta Inns. They were not chosen because of complex financial algorithms or indecipherable market trends. Rather, Lynch made these investments because he understood the businesses. He enjoyed Dunkin' Donuts coffee and saw firsthand the value La Quinta Inns provided to travelers. He recognized their potential growth because they were part of his everyday life. This shows that you don't need to be a financial whiz to make smart investments. It's all about putting some effort into understanding the business, its products, and its potential for growth. As Lynch shows, investing in what you understand can lead to significant wealth accumulation. So how can you start picking healthy stocks? Start with understanding the company, delve into their financial health, and invest in what you know. Train yourself a bit if you're unfamiliar with financial jargon, and don't be afraid to start. Research is your best friend here. It's your compass in the vast sea of stocks. Apply these steps and you'll be on your way to identifying those golden eggs. Remember, the key to building long-term wealth is not about getting rich quick, but about investing wisely and patiently in healthy stocks. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.